It is a pleasure to welcome back to Property Tribes TV, Graham Rowan, one of our favourite commentators around the economy. And Graham, it's lovely to see you again. And I think a good place to start would be to turn the clock back to July 2020, when you and I worked together on a series called Surviving the New Economy. And I have to say, Graham, I think that was one of the top content collaborations we've ever done. I thought your insights were almost bordering on prescient. And in fact, we are going to find out today that what you predicted, almost all of it has come true. And if we turn back specifically to one of the episodes, which was called The Lockdown Genie is Out of the Bottle, it seems to me that the inflation genie crept out at the same time. Do you agree?
Well, let's face it, you wouldn't have to be Einstein. If you take a scenario where you force everyone to stay at home, you effectively close down the economy, then you pump in gazillions of pounds of government handouts to try and compensate for that while people can't actually go out and spend it. And then suddenly again, you open things up and then there's all this money in the system. Oh my goodness, we've got some inflation. Who'd ever have guessed? Dear Lord. You do wonder about the caliber of people we have running the country, and indeed countries around the world, because clearly they are financially illiterate. Clearly they do not understand economics 101, unless, of course, there's method in their madness, which is to create massive inflation, devalue their currencies, and therefore devalue all the debt mountains that they've built up over the years. So, there's quite a lot going on, I think, at a macro level. And whilst I think obviously the economics of all this are very worrying, I think the politics of it is very worrying as well, because, we talked back then about strongman politicians like Putin. We've got Xi in China, you got Orban in Hungary. And once these people start tinkering with the constitution so they can stay in power for longer, you know what you're dealing with. And I think the measures that were taken during the pandemic, and I would particularly, I think, want to name and shame countries like Canada, Austria, New Zealand, and Australia as places I certainly will never, ever go to again, following the way they treated their citizens. It was so worrying how quickly we descended from Western democracy into almost following the Chinese model of kind of communist authoritarianism. That became the norm for government. So not only did the lockdown genie come out the bottle, it became almost a kind of beggar my neighbor competition between the different countries as to who could be the most extreme, who could do the most lockdown, who could pass the most laws to make all of their citizens into criminals. And of course, what's really ironic is that all the things that were said by people who were accused of being conspiracy theorists at the time, most of those things have turned out to be true. You look at the results of the vaccines and so on, and a number of people have been harmed by that. So, there's some really important lessons that we must push back on if we're to regain our liberty and our basic rights, as well as recovering the economy and the financial implications of what these jokers have done.
100% agree. And obviously in July 2020, we were looking forward into the future. But now, today, we've got the benefit of hindsight. And I have to say, Graham, and forgive me if I go on a slight rant here, I think the government's response to the pandemic in terms of the amount of money that was sprayed around at the time, that's hard to stomach now, because we found that bounce back loans were given to companies that had been set up for no period at all, had no trading record at all. We've had people arrested at the airport with suitcases full of cash from bounce back loans. The level of fraud within the COVID support measures is absolutely off the scale, unbelievable. And then we've also hearing of so many different measures that cost the taxpayer so much money. It's absolutely terrifying, the amount of money that has been printed and sprayed around and has left this country. And this is where the inflation genie is really beginning to bite. I think it's played into this whole narrative of inflation. Do you agree?
Well, I think there's so much to unpack there, but I think the first thing you have to accept is that politicians are pretty clueless people, and I think that I remember Ronald Reagan saying the most dangerous words in the English language are, "I'm from the government and I'm here to help." And clearly, everything they do tends to make a situation worse. You look at the war on terror, the war on drugs. They become just a bottomless pit of pouring funny money into. This is not money that ever existed anywhere. This is money being printed with the cooperation of those other jokers at the Bank of England or the Fed. And the problem with inflation is way, way worse than it ever needed to be, because our Bank of England bought into the Federal Reserve narrative that inflation was going to be transitory. And they were very late to the party. And to be fair, this notion that they are fighting inflation today is total BS, because look, we've got inflation at 10%. We've now dared to rise interest rates to 1%, which means the real rate of interest is -9%, which is the lowest it's ever been in all recorded history. So even today, they're not doing anything to fight inflation. Back in the 80s, Paul Volcker had to put rates up to, was it 18 or 20% to get the inflation genie back in the bottle. These guys are just dabbling at it. And it's almost like, they don't want to push too far in case people don't like them. Well, that's a bit too late. We have the governor of the Bank of England conveniently forgetting his 575,000 a year salary when he was in front of the parliamentary committee, and telling us all to tighten our belts and not ask for any wage rises. But of course, that's already happening. The labor market's so tight, people are asking for more money, or they're moving jobs for more money. So we're going to get wage cost inflation adding to food and energy prices. So I can't see how this gets better. I think it's going to get a whole lot worse, at least in the rest of this year and on into 2023. So boy, oh boy, is the inflation genie well and truly out of the bottle, as you say.
Well, the Bank of England governor has said that he hasn't got any more measures to try and curb inflation. He's got nothing left in his toolbox to do this. So, Graham, I am extremely worried. I'm not going to deny it. You are speaking to us from Portugal, and I almost feel like I want to come and join you right now, to be honest. As well as the obvious COVID pandemic, and all the things that have fallen out from that, which has had huge knock-on effects to such things like the hospitality industry and so on. Now, we've also got the energy crisis, which is affecting people massively in their pockets. Definitely going to affect tenant affordability in order to make sustainable rental payments. And then on top of that, we've got your strongman, Mr. Putin, who started a war, with Ukraine, which is also going to impact us as well. And all of these things that are in the on the track, and they're coming towards us. I don't think we felt the full impact yet of supply chain disruption, energy disruption. We're now even talking about energy rationing during the winter and next spring. That takes me back to the 70s. It's hard to believe that it's almost like the economy's on this runaway train, and nobody's got any driver to go and take the wheel of it.
Yeah, well, I read an article recently where the headline was the history book on the shelf is always repeating itself. And of course, we do feel like we're going back to 1974 when ABBA won the Eurovision Song Contest, and we've got high inflation but low growth, which they call stagflation. And of course, also, the government, you talk about the spending during the pandemic, their response to this is they're going to throw hundreds and hundreds of pounds at every household in the country to help with this cost of living crisis, rather than any kind of, means testing or trying rational kind of way of spending an amount of money. They're going to give us all hundreds of pounds. It'd be like the stimmy checks in America. So one of the bizarre things we have at the moment is a nominally conservative government that does anything but act in a conservative way. So they've clearly lost control of the economy, and they are you get this sense of total and utter chaos in 10 Downing Street and 11 Downing Street. You get the sense that they are bereft of ideas. They just don't know what to do next. So it's almost like they're, Dominic Cummings talking about Boris Johnson being like a supermarket trolley bashing against the side. You can see that what he said was true. They haven't got a strategy, a vision, a clear policy. And one of the things that amuses me at the same time as worrying me is how they try and pass off these simplistic stories. So in America now, Joe Biden, who, I think if we're talking in the Einstein stakes, is not going to register too high on that scale. He's now talking about the Putin inflation. So he genuinely thinks Americans are stupid enough to believe that all of this inflation is the fault of Putin's war. And also, they're talking about the energy crisis as if that's only come about since the Ukrainian crisis. And incidentally, whilst I'm here, I just want to say a huge kudos to you guys for what you're doing in Ukraine. I'm sure everyone on the Property Tribes platform would join me in congratulating you on the initiatives that you and Nick have taken there. I think that's amazing. But, the idea that somehow this energy crisis has only come about since February the 24th, which I remember well because it's my birthday, is such, again, total BS. And I'd say a lot more if this wasn't a family show. But, the idea that, we have got some kind of a coordinated energy strategy. I mean, the last 10 or 15 years have been a joke. We've been not doing anything in the nuclear world. We've been refusing to take fracking forward. We've got rid of all our coal mines. Germany's had to do a 180-degree U-turn on its energy policy. I'd love us to at least come up with some seriously coordinated policy because, again, we're focusing on net zero at a massive cost to the economy when it'll make a tiny, tiny difference to global climate change. We're locked into it through legislation, but, we've got to recognize we're going to need fossil fuels a lot longer. We're just not ready to make that transition. So you've got a total lack of a kind of government energy policy. They've lost control of the economy. The Bank of England is doing too little too late. And so now I think we're all just going to be buffered by events. And it's almost like we have to sit back and wait and see what happens because the government's seemingly powerless to do anything to help us.
Well, what they do, I have to scratch my head, Graham. I read today that Boris Johnson is thinking about reintroducing imperial weights and measures. Now, the food industry has immediately piped up and said, well, if you do that, it's going to cost us to change all our labels on our food, which is going to add to inflation. I mean, there's a time and a place for these things. And I often think, is it April Fool's Day? Is it the 1st of April? Because I see these things and I just can't believe that they're being put forward as a good thing to do right now. We need really, really strong leadership to get this country out of the economic mess it's in. And I just can't see anybody, in the past, the UK has always had the right person at the right time to come and solve a major, major crisis. Like we had Winston Churchill in the Second World War. He was the right person at the right time. We don't have, or I don't see anybody that fits the bill that's going to come like a knight in shining armor to come and try and save this country from all the awful things that are happening to it.
Yeah, and I mean, I think that there's an argument that says we get the politicians we deserve. And I think a lot of people have become so disengaged from the political process that, and a lot of good people do not want the kind of scrutiny that you get nowadays from 24/7 media. You do have to be practically a saint, to not have some kind of skeletons in the closet that will come out if you go into politics. But I tell you what, one of the trends I don't like, and I think, Tony Blair was probably one of the classic examples of this. We have this tendency to get younger and younger politicians who have kind of made it their career. They may have dabbled in something for a little while, like he was in the law, but often you sense that they go into politics to make a career of it, rather than having a career and then going into public service, which is kind of what used to happen. So I do worry about the caliber of politicians that we have, and it's not just in this country. You see this around the world. But what can seem to happen in some countries, and France was a good example of this, is that new political movements can spring up which reflect a change in the kind of zeitgeist, and can actually make a difference and get into power. I suppose the nearest we had to that arguably might have been UKIP in the pre-Brexit days. But if you look at Macron, his party didn't exist 18 months before the previous election. And then he not only won the presidency, he actually got the most seats in parliament. So in some systems, it can be done. It seems to be very challenging for a new party to make a real impact in Britain. But yeah, there's certainly a lack of leadership. And I think all I can say at a practical level is, when there's that lack of leadership at a national level, you and I have got to take control of our own personal financial situation and even our lifestyle. When we talked about, the wealth pyramid, and one of the layers in there is global diversification. And that's why I'm talking to you from Portugal today, because I took a decision along with my wife, Daphne, that, our lifestyle and our financial situation would be better served in another country. And, that sometimes you have to take those kind of steps, if you're able to, in order to put yourself in the right position. But that's because, in a sense, we each have to be sovereign in our own family situation. We can't rely on these clowns to make sensible decisions for us. In fact, what we're seeing is really worrying in terms of the way it's going with our finances. We've got inflation, highest for 40 years. We've now got taxes. The last time they were this high was just after World War II. And with these 5-year freezes on all the personal allowances, more and more people are going to go from standard rate to higher rate taxes on income. They're going to go into capital gains tax. They're going to go into inheritance tax. And they're going to go into things like knocking against pension limits and having to pay, 55% penalties and so on there. So, that's the financials. And then from a freedom perspective, we talked about the lockdown genie being out the bottle. Already they're trying to get us scared now about, monkey gland, this, that, or the other. And Bill Gates saying, oh, there's an even bigger pandemic coming. So I fear for liberty in a lot of countries as well. So all you can do in this situation is make sure that you are in charge, you're taking it all seriously, you're doing your research and making the right decisions for you and your family, both about where you live, how you invest, and how you can try and optimize your tax position and so on in an increasingly, I think, hostile world, and a world where those who have invested and have accumulated some assets are going to be targeted more than ever to pay their fair share and fund all of these handouts that you were talking about earlier.
Well, very, very wise words, Graham. I like this idea of being sovereign to yourself and taking control of the elements that you can take control of. Yes, it is doom and gloom, but you and I don't want to dwell on that completely, because actually in an inflationary environment, if you hold assets that are cash flowing and you're managing them correctly and maintaining them, you can actually do extremely well, because if in very simple terms, inflation can erode your debt. So all landlords that currently have portfolios up and running should be very focused on ensuring that their cash flow and their assets are maintained. What's your view on the property sector in this inflationary environment? Do you see any positives, Graham?
I think it's very mixed, to be honest. I think the first thing you have to be a little bit wary of allowing yourself to feel is the so-called wealth effect, because officially I think house prices went up something like 10.2% in the last 12 months. Well, if inflation is 10% as well, then you're kind of okay. You've held your own. You haven't really become 10% richer. So you've got to be a little bit careful not to get carried away with that. And really, property prices seem more than anything to be driven by interest rates. rates, the cost of money. And what we've seen in the past, for all the arguments about, oh, there's not enough households and we need to build more properties, I understand all of that, but that didn't really change things in 2008. You know, if suddenly there's no mortgage funding available, that does tend to have an impact pretty quickly on the property market. But I think we can possibly learn some lessons from some of the markets where they're in even a bigger bubble territory, like Canada or New Zealand, where property prices have gone up way more than they have here. They've now started ratcheting up the interest rates to 1.5% from the emergency pandemic rates. And what they've seen has been a big drop in the number of sale transactions. Mm-hmm. But so far, only a small drop in actual prices, maybe up to about 5%. So what they're seeing is far less, like 30 to 50% fewer sales going through, but at broadly the same price, maybe slightly less. And I kind of sense that might be the sort of thing we're going to see here, because one of the things that quite surprised me when I looked at the statistics on this is only about, I think, 1 in 3 or 30% even of properties that actually have a mortgage on them. And I think that's partly a demographic thing, because baby boomers like me own a lot of the property and we've already paid mortgages off. And very few, I think about 10% of those mortgages are on a variable rate. So if you're already locked into 2, 3, 5-year fixes, then these rates won't impact you for a long time. So, you know, the only way you're going to get a crash in property prices is if you've got loads of distressed sellers who've got to sell at any price. And I think we're a long way off that. Yeah, I don't think we're seeing that. So at the moment, my guess is, depending on how far they go with the interest rates, my guess is that we won't see a kind of big price collapse. I think we'll see a reduction and slowdown in the market, a softening of the market, but not a crash. I think the big unknown for me is where the main core economy goes from here, because we know we've got the high inflation. We also know we've got massive supply chain disruptions with, obviously, you know, Ukraine's kind of closed in terms of food exports. The Shanghai port is virtually closed because of lockdowns there. You know, a relative of mine owns a car dealership, and he can't get new cars because they're not producing them because of lack of silicon chips, etc. He can't get second-hand cars because no one wants to sell them because they know they can't get new ones. So, you know, as those ripple effects start to go through the whole economy, I'm hearing that, you know, input prices for manufacturers are getting so high now that there's a kind of they've been holding this behind a great big dam and absorbing it. It's about to burst, you know. So prices generally, I think, are going to continue escalating. So at what point do people say, well, you know, we just have to cut back? You know, we can't spend this much on dining out or holidays or cars or whatever. And that could lead us into a recession, which then said, I can't afford to pay as much rent, or I can't afford to pay as much for a house. So I think, you know, that there's these conflicting pressures, and I don't know quite how bad the core economy will go. Are we going to go into a recession this year? Some people are saying it won't happen until next year, but it's hard to believe we're not going to go into some kind of recession. It's quite hard to see how bad it will be and how long it will last, because I suspect, you know, that will determine how much impact it has on the property market.
Well, we are fortunate that the property sector has been incredibly resilient to all these horrendous shocks of Brexit, COVID, and now the inflationary environment. We're still seeing very, very high tenant demand. I think that will continue, because during these uncertain times, people are less likely to make a large financial commitment like buying a house, so they may well stay in rental accommodation till they feel more confidence. I mean, so much of this is based on people's confidence, and you know, I don't think the mainstream media helps at all with all their shouty headlines about all the awful things that are going to happen that may never come to pass. But I think as we discussed way back in July 2020, when we did our, you know, Surviving in the New Economy series, I think people that took those pointers on board will have fared a lot better than those that didn't. In other words, people that made themselves aware of the issues, were proactive in doing whatever they could do to protect themselves from those shocks, they've probably done quite a bit better than those that haven't. And I feel, Graham, that we're in another pivotal point here where we do need to be taking some kind of action to protect our sovereign position, as you have so eloquently described it. Now, you've, in your economic wisdom, have come up with a kind of 3-point plan for Property Tribes members to think about implementing, and you're going to share that with us now, aren't you?
Yeah, I mean, as you probably know, I chair something called the Beaufort Society, which is a kind of private members club for high net worth investors. And what we found has been very successful, this year, last year, is what we're doing in a thing we call property connections. And that's where we effectively, we're like a sort of dating agency connecting investors with liquid funds to developers who've got shovel ready projects. But we put them through quite a bit of due diligence, because there's really, yeah, as you say, there's kind of 3 factors that I think really matter today. And I think, it's much harder, I think, I don't know, if one of the of our viewers is kind of new to the property world, the traditional thing that we still see gurus selling. We met at the property investor show earlier this year, where they're still pushing strategies from 10 or 15 years ago about buying a 2-bedroom flat and somehow making it cash flow positive. These are very challenging things to do these days. So one of the first things we focus on is forced capital appreciation. In other words, regardless of what the market's doing, find a way of adding value to that property. So the starting point for us is even geographical, because obviously, as you know, there's not one property market, there are hundreds of property markets. And we've found a lot of good projects in the northwest of England. And what we're doing is we're looking at existing properties, which are then being stripped out, refurbished, extended where possible into the roof or into the basement or out the back or out the side, so that you're forcing that added value regardless of what the wider market's doing. So you're almost certain, if you manage the thing properly, to end up with some profit. So point 1 is, obviously do your research on the market, make sure you know what you're going to be selling to whom or what you're going to be renting to whom, buying well, clearly. I mean, this is stuff that's everyone's familiar with. But the point is, when you appraise that project, where can we add the forced value? So a couple of examples from our recent experience. In one scenario, we'd already started on the project, and then the developer said, look, we could take hundreds of barrel loads of earth out of the basement and actually create a flat down there. So we stuck in a planning application for that, and we actually got the thing accepted. So we were able, on a project that already made financial sense, to add another apartment in the basement, and that put another 200,000 into the profitability of the project. Another example was a fairly, frankly, bog standard 3-bedroom semi up there, and we just extended out the side, but we also built a really high-end home office in the back garden, which these days, obviously, post-pandemic, work from home, etc., became a really valuable feature and added a lot to the value of the property. So look for ways in which you can force that added value. That's point number 1.
Can I just jump in there, Graham, and
Please,
say,
yeah.
I really, that the idea of adding a home office is actually something that I've been advocating as well, because, as you say, it forces the appreciation of the property. It will make it more desirable to rent and perhaps attract a premium rent. But also, obviously, it's a capital expense as well, I believe I'm right in saying. So it's tax efficient. And, in this current market conditions, my view is to go for the highest quality that you can, because I believe that areas of where there's wealth, where there's a lot of employment, where there's a lot of financial industry, like the big cities, they tend to withstand economic shocks better than places that don't have those kind of features.
Absolutely, and the properties I've been describing are all in commuting distance of town centres and major centres. They're not kind of in the middle of nowhere. Absolutely. So that's point 1. Point 2, especially if you're going to be partnering with a developer in this kind of context, is to have a really strong shareholder agreement, because you're going to be investing in the SPV, the special purpose vehicle company, for that project. So we put a lot of time into the shareholder agreement, with a particular emphasis on the flexibility of your exit strategy. So, for example, in a really strong market, you're just going to buy the place, you're going to refurb and extend, and then you're going to sell it, and you're going to make a nice chunky profit. What if the market softens in the next 12 months? We've just gone through all the reasons why it might. So you need to have the shareholder agreement already saying that in the event of that, we can go for a refinance with, say, buy-to-let mortgages, and we can rent the places out for 12 months, see what the market's like after that. Or maybe we do, if there's 5 or 6 units in the development, we sell 3 and rent 3. We just want that flexibility of exit option, because nobody can predict exactly what's going to happen in the next 12 months, although we've certainly got a direction, I think, that we're heading in, which is definitely going to be challenging. So if you've got those options, you're giving yourself the maximum possibility of coming out of this in a good place. So make sure the shareholder agreement protects you in that. There's also a few other things we do, like we kind of put the money in as a loan, so it gets paid back first ahead of the other, ahead of the developer and things. So we put a lot of time and attention into protections in that shareholder agreement. Don't rush into these partnerships. Don't think because it's a mate or something like that, that it's okay. Really get some proper advice on that shareholder agreement if you do joint venture with somebody.
Yeah, well, let's just extrapolate that to people that aren't doing joint ventures. What I would kind of say about that is, again, think about your exit strategy, because when, as you say, life can throw many curveballs. You might be thinking, well, I'm going to hold this property for 20 years, but then something comes along in 2 years' time where you've got to sell. My feeling is that you shouldn't buy anything that has some kind of impediment or issue that you cannot remedy, because if you do need to sell quickly, the prospective buyer is going to see that impediment with the property, and it's not going to attract such a high price. So when you're looking to force the appreciation, one thing you can do is look at properties that are unmortgageable, because then they become open to cash buyers. But you must make sure that the reason why they're unmortgageable can be fixed. And if you can fix that reason, such as, say, a short lease, for instance, you can do a lease extension and then the property becomes mortgageable. That's a really good way to force the appreciation.
Absolutely. So point 1 is forced appreciation. Point 2 is flexible exit strategies. Yep. And then point 3, I would add, we talked earlier on about taxes being at a 70-year high. Now, with the caveat that I'm not a tax advisor, I would say point 3 is to optimize the tax position of your investment. So let me give you a couple of examples of what I mean. If you have already got your property portfolio in a limited company, and you make the investment in the SPV for this new project through your limited company, you can then take dividends from the SPV back into your company free of tax, because there's no tax on dividends paid between companies. So if you invest through a company, you can avoid paying tax on the proceeds. Another option is if you own and operate a trading company, let's say you're just in business doing something else, you can set up what's called a SAS pension alongside that company, a small self-administered scheme, and they are far more flexible than things like SIPs in terms of what you can invest in. And because you're buying shares in a company rather than actually putting residential property directly into your pension, you can do this through your SAS. And you probably could actually do it through a SIP, but it's easier through a SAS. So then you invest from your SAS into the SPV, and then any dividends go tax-free to your pension, and then eventually the sale of the property goes tax-free into your pension. So imagine if you could avoid paying all that income tax and all that capital gains tax on the project. That gives you another 20, 30, 40% cushion on all of these numbers in a challenging market. So it's more important than ever to optimize your tax position. And one of the things I would say to you is, what has your accountant done for you lately? Because a lot of people, I find, get far too lethargic and apathetic about having the same accountant year after year. He's become a mate that you go for a beer with. You wouldn't want to upset him. Well, when did he last proactively come to you with these kind of suggestions? And I find that accountants are a bit like cleaners. They start out doing a great job, and then gradually over time, they might just cut a few corners, or they might just delegate your work to the junior staff. And then suddenly you find you wake up one day and think, my house doesn't feel very clean, and you have to go out and find some new cleaners. Well, it's the same with accountants. You might find that initially you've got the partner working for you and he's really, trying very hard. Over time, the practice expands and you get less and less time. And probably best not to be too cheap on this, because the more you pay, generally the better advice you can get. So make sure your accountant is helping you with this, and if not, change your accountant, because there's plenty of them out there. So make sure you're getting really good tax advice on how you structure these investments, because now more than ever you need to hang on to as much of that profit as possible.
Well, absolutely. And I also would say that, working with a reputable mortgage broker would really help you during these challenging times as well, because they have access to whole of market. They know the products out there that could potentially help you move forward. They know the criteria of products. I don't know what you think, Graham, but I'm already getting a little bit of a feeling that the lenders are going to start to pull their horns in a little bit. We're seeing there are still a lot of mortgage products around, but rates are starting to rise. I mean, the availability of finance, the property market depends so much on it, doesn't it?
Absolutely. And I think, in a situation like this, it's better to be a year early than a day late. Because when these things happen, they tend to happen quickly. So now is the time to be trying to future-proof your portfolio, whether that means locking in longer-term fixes, even at a slightly higher rate, or selling properties that no longer work for you. Those are the decisions you should be taking today, and not just hoping it's all going to be okay in 6 or 12 months, because there are just too many uncertainties. I mean, we've been talking to each other over a number of years now, Vanessa, and I would say there's never been a more uncertain time than we are in the middle of 2022 here. So there are so many variables that none of us has any control over. We know we've got idiots running the country. We've got jokers running the central banks. We've got warmongers in Central Europe. We've got, strongmen dictators all around the world. So there's so many things that could go wrong. So now is the time to get ahead of the game, have a greatly, very close look at your portfolio and see what you can do to really lock in your position where you can, or to get out of a position where you think it's going to turn against you. Because when it starts to happen, it tends to happen quite quickly. And if you're 6 months ahead of the game, that's a far better place to be than a day late and a dollar short.
Well, I couldn't agree more. And strangely enough, there's thunder in the background, which is giving me a little Graham, I love your advice. I think it's absolutely spot on as always. And I think this is one of the benefits of social media, that people do have access to good quality information like this. And I know that you would join with me in inviting everybody to really take on board the kind of issues that we've been discussing within this Zoom call, do their own research, make sure they get the right advice from the right source. If you're not sure, ask for recommendations on the forums, and really just think about future-proofing your property business. You don't fix the roof when it's raining. You fix the roof when it's sunny. And right now it does feel quite sunny. We've got the Queen's Jubilee coming up. We've got the summer holidays to look forward to. Now is the time to fix your portfolio roof, so to speak.
Absolutely, and obviously Property Tribes has got a tremendous depth and range of resources to help with that. So yeah, just use everything you can on the platform, do your research, and get in ahead of the masses, because one of my big bugbears is that most people are not financially literate, and for those that take the time to be on a platform like this, you are in a tiny minority. You're probably like 3% of the population, so congratulations for being part of that group. But yeah, absolutely, now's the time to take action before the masses find out what's going on, and suddenly everyone will be doing the same thing. So take action now, be ahead of the curve, and you should be okay.